23 seconds away from the opening bell in New York this morning. Good morning to you all. Coming off the back of the first down day in 3 on the S&P. We are totally unchanged on equity futures on the S&P 500. Likewise on the Nasdaq, following the smallest of upside surprises on the inflation report in America. Here's your opening bell in New York City. Switch at the board and get to the bond market. Yields were higher, then they were lower, now they're higher again. 428.62 on a 10-year, still near 430 on a 2-year. Still near 5% on a 2-year yield. The dollar just a touch stronger against the weaker euro. The euro in a world of pain. Let's sit there just for a moment. Stuck between a rock and a hard place. President Christine Lagarde. Germany set to revise its growth outlook lower for contraction for the rest of this year. And then on the other side of things, the ECB reportedly ready to upgrade its inflation outlook for next year to above 3%. What do you do with that? 107.47, Nomura looking for 105. In the commodity market, new highs for the year on crude, $89 a barrel on WTI. We're positive there by 0.2%. 40 seconds into the session, we're going absolutely nowhere on the S&P 500. Likewise on the Nasdaq. One stock to look at, it's Apple. Its launch event overshadowed by headlines out of China. The country's foreign ministry saying this: we've noticed there have been many media reports about security incidents concerning Apple phones. Ed Ludlow can explain this one. Morning, Ed.
Yeah, good morning, Jonathan. I would just point out Apple is modestly higher, 0.2% and rebounding from that 1.8% drop on the iPhone launch event day 24 hours ago. If you don't mind, I'm going to read the quote again because this is a nuanced story. During a briefing, Chinese Foreign Ministry spokesperson Mao Ning said the following: "We noticed that there have been many media reports about security incidents concerning Apple phones." What happens in these briefings in China, John, is that there is a real-time Chinese or Mandarin exchange and a simultaneous English transaction. And what we note in our Bloomberg report is that the English translation omitted the phrase media reports. The significance is this is the first time that China has publicly acknowledged the reporting by Bloomberg and others that China's central government has instructed government agencies and state-backed enterprises to inform staff not to use a foreign handset, including iPhones, and to switch to a domestic handset. What is really important with this story is that the spokesperson Mao Ning went on to say that China has not issued laws and regulations to ban the purchase of Apple or foreign brand phones. And actually, if you look across the media landscape this morning, many outlets leading on that there is not, according to this spokesperson, an outright ban. The shares up now 0.5 percentage point. Remember, we got exactly what we expected at that iPhone event yesterday when I was down in Cupertino. iPhone 15 Pro, $999. If there was any surprise, and this is what the sell side's jumping on, it's the slightly higher price point of the 15 Pro Max, $1,199 or $1,200. But with the starting model having 256 gigabytes of storage, they want to see them use the lever of the higher prices, knowing that driving unit volume growth is really hard for Apple right now. It was an all singing, all dancing, bells and whistles phone, John. It's exactly what Mark Gurman reported it would be, and it was a classic iPhone event down in Cupertino.
Ed, you and Gurman, great coverage in the last 24 hours. Thank you, buddy. Ed Ludlow there on Apple. Let's turn to the auto sector. The EU launching an investigation into Chinese subsidies for EVs to ward off cheaper imports. European Commission President Ursula von der Leyen saying this: their prices kept artificially low and it's distorting our market. Abby has more. Hey, Abby.
Hey, John. Yeah, pretty protectionist behavior here out of the EU toward China and the China EV makers. They are launching an investigation into Chinese subsidies for EVs. And the reason really has to do with the growth of China EVs, sales of China EVs in Europe. In 2020, they had 1.1% of the market. Now in 2023, they have 5.6% of the market. So over just a couple of years, 4.5% growth. And of course, there are many German automakers, BMW, Volkswagen, Audi, Daimler, that have EV vehicles to sell, many of those starting above $100,000. So the EU really looking into whether or not these subsidies are helping China and those China EV makers take share. It's not clear whether or not actual tariffs will come from this. Earlier, the German automakers had been higher. Now they're basically about flat on the fear. Will China retaliate relative to the stocks, John? It's interesting because on the year, NIO up about 6% on the year, BMW up about 16%. So it seems as though the EU probably not thinking about share prices, but potentially this could protect investors of those those automakers as well.
Oh, this is so important. Abby, thanks for this. This connects to the story here in America as well. How do these names compete with rivals in China on a cost basis, particularly with this UAW dispute taking place as well? This line from Mr. Farley over at Ford, there is a line in the sand for the sustainability of the company. They're thinking about how they can compete with Chinese EVs as well. We're about 5 minutes into the session. We're just about positive by 0.2% on the S&P. On the NASDAQ, up by 0.1. I want to turn to the airlines. This was big news earlier this morning. Spirit and American both cutting their forecasts, citing a rise in jet fuel costs. Spirit also citing heightened promotional activity and steep discounting. Those stocks getting hammered over the last few months. Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, higher fuel costs going to cause both Spirit and American to adjust either their revenue or their earnings per share forecast. Spirit slashing its revenue forecast for the third quarter. It was looking for $1.3 to $1.32 billion. Now it's looking for $1.245 to $1.255 billion. This on a jet fuel cost estimated to be at $3.06 per gallon. That's about 26% higher. 26 cents higher than it had previously anticipated, talking as well about that lack of demand, that steep discounting that it's been doing, especially seen it in the past 3 weeks, going to extend, it says, through the pre-Thanksgiving period. American also seeing now $2.90 to $3 per gallon jet fuel costs in the third quarter, that forcing it to cut its adjusted earnings per share from 85 to 90 cents or 95 cents to now 20 to 30 cents. Also saying it's got to account for some of those payments, roughly $230 million to airline pilots under its new contracts. We saw some of the reflection of that the falling airline fare costs in the CPI data this morning. Airline fares down 13.3% from last August, and this really taking a hit on all of the airlines in trading today.
So we're told. We're just not feeling it quite yet, Simone, but I trust the data. Hopefully fares are coming down because we all want them lower, don't we? Simone, thank you. This market picked up the scent of this story over the last couple of months. Airline stocks on the S&P 500 down by more than 22% from the highs of July. More than 22%, that move lower off the back of these negotiations with the labor story. Airlines, American Airlines, I'm thinking of them. Higher jet fuel prices off the back of this move in crude in the commodity market. I'll give you the update at the moment. WTI just short of 89. Brent crude through 92. Let's finish on the banking sector. Citi preparing for a wave of job cuts as it restructures to operate from 5 main businesses. The Wall Street giant saying this: as Citi swiftly transitions to this new model, the firm is committed to retaining top talent and supporting employees who are leaving the company. Shanali has more. Hey, Shanali.
You have Jane Fraser, the CEO of Citigroup here, John, just taking an axe to Citigroup's management structure, now having 5 business heads with all of the groups rolling up to those 5 in particular. Now, who does that include? It includes the unequivocal trading and markets head, Andrew Morton, as part of that team. And very surprisingly here, you have Peter Babet, the head of Asia Pacific, now becoming the interim banking head, leaving open a position at Citigroup and putting them on a search for a new division of one of the top 5 M&A, IPO, and debt underwriting advisors across all of Wall Street. Now, this could be pretty painful for a lot of managers across different divisions over the next couple of months as they figure out just what other layers beyond this top 2 start to go away. Initial reaction from the market is they like it. This may result to a very streamlined bank after Citigroup has already exited certain markets. They don't have yet financial results across these new business lines or a target of what that full workforce reduction would look like or the severance costs associated with those reductions. But at the end of the day, a year from now, you might have a much more streamlined Citigroup.
Brilliant reporting, Shanali, through this morning. Looking forward to more from our chief Wall Street correspondent on the latest on Wall Street with Citi. Want to get to Morgan Stanley's Caterina Simonetti, expecting late cycle sectors to outperform and adding this: pay attention to fundamentals, stick to quality, and have a longer term investment view. Stay disciplined and recognize the pullbacks in the market as potential buying opportunities. Caterina, I'm pleased to say, joins us now. Caterina, let's start with this phrase, late cycle. I've said over the last few months, it feels like the economist who cried recession through the whole of this year. I was told late cycle. Why are we well and truly in late cycle?
Well, John, thank you for having me on the show. And one of the things that we're seeing right now is this very conflicting data. And let's take a look at the inflation numbers this morning, right? On one side, we see inflation coming down, but we also see parts of it that are still up, which is very concerning to consumers, like energy, real estate prices, rents, the services, travel. And this is very typical of the late cycle where we see this conflicting data. Unemployment a few weeks ago, actually is coming down. At the same time, we see enormous pressures on earnings and profit margins, and we're expecting that to be translated into, some of the dibs before the end of the year. So therefore, in our view, we think that we are in this late cycle, which means that, on the flip side of it, eventually things are going to start getting better, but we're not quite there yet.
Katerina, let's build on that and stick to energy just for a moment. Brent at 92, WTI just short of 89, 88, 90 something this morning. Energy stocks on the S&P so far this month before today up by more than 4%. Is that a move I want to stick with or a move I want to fade?
Well, Jonathan, so far this year, the stocks that performed for this Magnificent Seven, right, the area that already was the leading sector in the last bull market, and yet, we were kind of all on the bandwagon that was going to be the sectors to stick in. And what we think that investors should stay with quality. They should be fully invested through this market cycle, but at the same time, they need to stay defensive. And one of the top areas in this defensive play would be energy, because a lot of energy stocks pay good dividends. We use a lot of energy. We all drive our big cars, especially here in the United States. So the energy use is there. And we think that energy definitely plays a very significant role in the portfolio, along with financials, healthcare, industrials, materials. All of these are sectors that we would like to see in portfolios because we like the positioning, we like valuations, and we also like the fact that these sectors are paying very good dividend yields, which is important.
They're the price makers as well in energy, so let's talk about the price takers, the airlines. The airlines at the moment have to absorb those higher energy prices that we've been talking about. And what we've seen this morning, what we've witnessed, are basically downgrade cuts to the outlook at Spirit, at American Airlines. Katerina, I know you can't do single names, but for the sector, for the airlines, what area of discretionary spending do I want to be in right now? What do I want to avoid?
Well, I want to answer your question with focusing on consumers. And consumer has been under tremendous amount of pressure. The inflation is real, and, seeing the prices go up, eventually kind of curb that enthusiasm that we saw, coming out of COVID, where, we were so deprived of travel and we wanted those experiences, and we see the prices of air travel going up. But how much longer can it last? Specifically as we're facing the reality that interest rates might be higher for quite some time, and that we see the companies cutting costs, we see layoffs, and all of that really puts pressures on consumer confidence, where, they might be a little bit more reluctant to spend money, on this excessive cost of travel, and we see the incentives, we see prices of the airline tickets coming down, but not enough to really incentivize people to continue to travel quite at the same rates as they have been, so this is the sector that we are telling our clients that they should probably avoid for a while and stick with more defensive plays.
Bank of America this morning, tight labor market, solid balance sheets, lower income resilience, and goods deflation leave us constructive on the consumer. Katerina, your story, do you expect it to show up in the retail sales number we get tomorrow morning?
The retail sector is a little tricky because, again, when we look at the inflation and when we look at the data that is coming out, that's the first area where if you're going to save some money, what are you going to continue spending on consumer staples, on energy, on healthcare, on things that we absolutely cannot go without, but we see the weakening in retail, and it will be interesting to see what the numbers are going to tell, if they're going to support the story, but most likely we're going to see some weaker numbers.
We'll see. Katerina, thank you. Katerina Simonetti there, the latest from Morgan Stanley, looking ahead to that retail sales print that we get tomorrow morning. Coming up on this program, the IEA's crude warning.
With the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk tightening the market, increasing increasing volatility.
Team coverage up next with crude prices at 2023 highs.
Market is really tightening in the second half of the year. Already in August, we saw global oil inventories falling by a massive 75 million barrels according to preliminary data. And with the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk tightening the market, increasing volatility.
The IEA warning that Saudi and Russian production cuts will create a significant supply shortfall, writing this: oil stocks will be at uncomfortably low levels, increasing the risk of another surge in volatility that would be in the interest of neither producers nor consumers given the fragile economic environment. The announcement coming as Brent hovers at 10-month highs above $92 a barrel. Your team coverage starts right now with Bloomberg's Anne-Marie alongside James Herron. James, can you talk to me about how big that supply deficit is going to be later this year?
Yeah, well, the market's already tight, and it's looking like it's going to remain at least just as tight. You heard the number from the IEA there of 1.4 million barrels a day in the fourth quarter. Interestingly, the numbers from OPEC actually are almost twice as large for the supply deficit, largely because OPEC has a much more bullish view of demand. So really, the difference may come down to how the economy's doing, and very particularly how China's doing.
James, do we have a decent idea of how that demand picture looks like, what it looks like in China currently?
Well, there's been a lot of talk about China's weakness, but some analysts who've recently been reporting on China, some who've even traveled there, are saying that oil demand is stronger than you would think, given the weak state of the economy, and there may even be a decoupling between the strength of oil demand and the broader economy there. So perhaps the more bullish estimates of Chinese demand will turn out to be correct.
Anne-Marie, the President would like a good story to tell about inflation. Does this crude market complicate that?
Oh, it certainly does, Jonathan. And the cherry on top of the cake for that has to be today's inflation report, with gasoline being the single biggest contributor in overall prices moving up in August. And when it comes to the psyche of the American consumer, there was a survey done last year. Remember when gasoline prices over the summer were about $5 a gallon? The issue is that when consumers see higher pump prices, which are on every side of the road, it starts to affect how they are going to use their paycheck to paycheck. How are they going to decide what they are going to buy? And it starts to impact actually some of the feelings they have about their pricing power, their purchasing power in the United States of America. The president, the latest polls show he continues to get poor report card when it comes to his handling of the economy. Quinnipiac says it's only a 36% approval rating on the economy, and the biggest issue for him is inflation and gas prices. That is going to be a very difficult one for them to really try to sell Bidenomics on if pump prices are going up.
James, final word. This is happening with crude output in America near record highs. It's happening with the SPR drained after the events of the last 18 months or so. James, just how vulnerable is the US to a price shock with all of that in mind?
Yeah, as you say, there really aren't a lot of levers that the Biden administration can pull, especially when the relationship with Saudi Arabia doesn't seem to be on particularly good footing. As we know, last year the White House was pressuring the Saudis to open the taps, and they did the exact opposite, and there's no sign of any shift in that relationship right now.
WTI 88.50, Brent crude just short of 92 now, breaking down a touch, 91.90. AMH, James, thank you for the latest in the crude market. Let's get the latest in the equity market, some sector price action. Here's Abby.
And the sectors this morning are pretty evenly distributed to the extent that they can be, given that there's 11. But the reason I say this is we just have a few, one more that is lower. Energy down about 0.6%, with oil's small decline, and then 5 higher, but consumer discretionary up just about the equal amount to the upside, being led by Amazon, Tesla, Ford, and others. As for those airlines, though, John, let's take a look at that decline you were talking about off of the July peak. It's really pretty brutal. So American Airlines today, not really completely not priced in, not new to investors, basically a bear market over this time period, as investors do worry about these rising costs. And will airlines be able to manage them, and will there be demand from travelers?
Abigail, I'm with you. This market's been there already. It picked up the scent of this news that we got this morning. We're down over the last month by something like 8%, and based on that chart that Abby just put out, from the highs of July, we're down more than 20% from the highs of July for that industry group. About 23 minutes into the session, we are positive here by 0.1% on the S&P, on the Nasdaq up by 0.1% also. Inflation data, the tiniest, the smallest of upside surprises on core CPI, drove yields a little bit higher initially, then that move faded pretty quickly. Yields on the 2-year lower by 2 basis points, just above 5% at the moment on the 2-year. On the 10-year down about a single basis point, still in and around 430 at 427. Up next on this program, your trading diary. 25 minutes into the session, you know what we say, no drama here really on the S&P 500, up by 0.1%. Similar move on the Nasdaq, some slight underperformance again on the Russell, the small caps pulling back by about 0.4%. That's the price action. Let's get to the calendar. This is how things are shaping up in the trading diary. Thursday, tomorrow, initial jobless claims, US retail sales and an ECB rate decision, plus the UAW strike deadline at midnight. Friday, some economic data out of China, including property prices and industrial production numbers. Sneak peek of next week, next Tuesday, President Biden in New York for the UN General Assembly, and on Wednesday, the main event for us on Wall Street, a Fed rate decision and Chairman Powell news conference. All of that around the corner still to come this week and beyond into next week as well. From New York, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, September 13th. Here are the top market stories that we're following for you at this hour. Inflation re-acceleration. Core prices rise for the first time in 6 months. A November rate hike comes back into play. And Citi overhaul. CEO Jane Fraser makes a surprise appearance at the Barclays Global Financial Services Conference to talk about the biggest reorg in 2 decades. And armed up, ready to go. ARM could price its IPO at the top end of the range or higher. We see what other IPOs are ready to walk the walk.
From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. One of the questions that I had, Guy, coming into today with CPI is, was the market going to trade and react correctly, have the correct interpretation of the CPI data?
I think the market's interpretation today looks like it doesn't see it as a game changer, but clearly the fact that the Fed is back on the table, I think, is significant. I do wonder whether the market is now focusing on other things, though. Inflation has been a real issue for a while, but growth looks like it's becoming an increasing issue. It's a similar story over here as well. European inflation doesn't look like it's going away anytime soon. It looks like it's going to be sticky. The growth story over here clearly looks weaker, but I do wonder whether that's the story the market's sniffing out today, whether or not actually it's going to be a similar narrative over there with you.
I know, but I'm kind of still waiting for that to come down. When you have airfare prices were up, you had car prices were also up. Maybe that's a supply issue, but that feels like maybe if it's more of a demand issue, then that's something different.
I blame Taylor Swift. It seems that Taylor Swift is responsible for most things at the moment. Taylor Swift clearly is responsible for inflation.
I mean, you joke, but that's actually not entirely crazy. Even the UK data, it was like entertainment and sports venues, but not just sports venues, but all of that really contributed to higher inflation.
Absolutely. Honestly, Taylor Swift. If the answer, whatever the question, the answer at the moment does seem to be Taylor Swift. Anyway, our question of the day may not have the answer of Taylor Swift, but maybe it does.
I think it does.
Inflation reacceleration. That sounds like a song title as well. Maybe that could be Taylor Swift's next album or next song. Anyway,
wow.
We'll park the end.
Something.
I know. I'm stretching it now. Endicott and Liz McCormick are going to rescue me. I'm sure they've got views on this as well. To answer our question of the day, is this an inflation reacceleration? And is that actually the issue, or is it growth that we need to worry about? Liz, what do you think? What do you see happening in inflation? And is it the biggest threat, or is growth now taking over?
Well, I think, first of all, one of my old bosses used to say, never say the market's wrong. But like you said, sometimes you wonder, are they trading right? But I think today's, the inflation, the super core, which the Fed is focused at, obviously that was stronger than expected, but it was kind of one sliver, that transportation services. But the question is, does that continue? So I just think this data wasn't enough for clarity on the Fed's outlook. But yeah, you're right. Combined with inflation, so far we haven't seen this recession play out. Growth has been good. Maybe it's the Swift concerts, whatever, which I didn't go to. But I think the market is going to say, yeah, that's going to weigh in. Chairman Powell seems to really want to pull off a soft landing. So he doesn't want to kill things. But, they do need to see the labor market slow. And we're seeing signs of that start, but I don't think enough. So I think the Fed is still weighing both sides of the mandate, like you said, Guy.
So, Endo, what do you think? Inflation reacceleration? I mean, I can make the argument, say, take Southwest, right? They see lower airfare prices, but then we also have a potential auto worker strike, which could then maybe elevate prices. I mean, how do you view that?
I think the best line I saw this morning on it, Alex, was just when you thought it was safe. I think the broad story in inflation is, look, things are heading in the right direction. You'd have to say the soft landing odds are a lot better than where they were. But when you look at what happened to core inflation, like Liz was talking about there, that is a little bit of a surprise and a jolt in the opposite direction. It does suggest perhaps stickiness in the system, and this is where it becomes a big judgment call now for the Fed. Are they going to look through some of these increases, be it in energy, be it what's going on in car insurance, be it what's going on in new cars, for example, those sectors that saw increases, or will they put another rate hike on the table? And I think the sort of broad view from this is that September is a done deal, they're on hold, but it's certainly for November, if not December, it does raise the possibility of one more rate hike by the Fed, perhaps, to make sure of it. And that's where things start to get really tricky, because then, to your point, you're dealing with a slowing economy and, of course, ongoing sticky inflation.
And the problem over here in Europe is that we've got both of those two things simultaneously. Looks like we've got sticky inflation and slowing growth. Is that the direction of travel for the Fed as well?
Well, that's the big danger. There's no doubt. I mean, there have been two very different stories. Of course, inflation story in Europe quite different to the US. And broadly speaking, the US is in a much better space than I think most people thought at the beginning of the year, Guy. But the big question is, where does it go from here? We're already seeing some warnings from small businesses, for example. They're talking about having to increase their prices that they're passing on to customers. We know that the labour market is certainly softening at the margins. And now this data this morning, at the very least, it will keep the Fed Fed alive to the possibility of further tightening. And when you combine all of that going into the year end, start of next year, it'd be a brave person to say the US economy is going to re-accelerate. So you'd have to say the pressure will be on the growth side of things, even when the inflation story hasn't totally gone away.
Mm-hmm. Yeah, Guy, this makes me think of the NFIB chair that we talked to yesterday that said it's not so much a demand story at all. It's still a price story for the small businesses. And you wonder if inflation is just volatile, like forget up or down, it's just volatile, how do you deal with that?
It's a real challenge, and many of those businesses also are frustrated that there are going to be pockets of demand out there that they want to take the opportunity to profit from, but they can't because there's various other factors, some of which are inflation, some of which are labor related, that are getting in the way. I think the real question here is kind of, as you look at that growth versus inflation challenge, kind of where do we settle down, and for how long? How hard are central banks going to be prepared to hit inflation? What are they going to tolerate if we're in an environment where growth is slowing? Liz, what do you think? Does this raise the question of the fact that maybe we have to live with 2.5%, 3% inflation if the growth metric is rolling over?
Well, I think at the last, I think it was at Jackson Hole, Chairman Powell made clear, like, hey, we're not giving up the 2% mandate, even though they don't pencil it in and getting there until like 2025. So I think they're going to not want to signal that. But I think officials, like even Lori Logan, a known hawk, has kind of said, we can kind of look at the data now. We've done like the hard hammering, and I think that they really don't want to crush the economy, so they can be more careful.
Yeah.
But I think, we got to look at next week. Chairman Powell's going to talk. We have a new dot plot. The traders are going to be really fine-tuned looking at, did they leave the hike?
Yeah. So to that point, you think November's in play now, though?
I don't see how you can write it off. Market's about 50-50, touch less than that. I think today's data wasn't enough for people to say, no way, we're done for sure, even though a lot of people forecast that. So I think, we want to hear what Powell has to say. Does he kind of try to keep that alive or not? I just think today wasn't enough to just say, lean in for sure or they're done.
And is Jay Powell in control of the inflation narrative, or is President Biden in control of the inflation narrative from here? Oil prices are rocketing higher. Is the administration going to be able to do anything about that? If the economy slows, the temptation is going to be for the federal government to spend. Now, that's going to have a negative impact potentially on yields, or a positive impact on yields, negative impact on bonds. But is the federal government kind of where you want to look for the direction of travel here, not just on growth, but also on inflation, because that's where the spending is coming from, and that's where more spending potentially could come from further down the road?
I think that's the space we're in now, Guy. You have to ask yourself, what can the Fed do about energy costs or oil costs? And indeed, what can any central bank around the world do? This idea that the low-hanging fruit is done, the sort of broad-based hammer that higher rates bring to demand has done its work. Now you're getting into the sticky areas, the complicated areas that are well outside the kind of classic purview of central banks. So we'll have to see if the governments will have a role in this, be it on the energy side or broader areas of the supply side story. I think, though, when it comes to putting more money into the economy, Guy, if we reach the point where the US needs support from the fiscal side of things, that will become a whole other story here, because the debate over debt and deficit is already very contentious with the risk of that government shutdown in a few weeks, for example. So we're getting into the pointy end of things now, and I think policy decisions, both monetary and fiscal, are going to get very complicated from here.
Yeah, I mean, Guy, President Biden is just releasing his thoughts on inflation, saying that core inflation is trending down. Okay, they know the increase in gas prices are straining family budgets, and they're focused on cutting energy costs and boosting clean energy. That's not going to come fast enough, and the administration is going to be out of tools. So I don't know what you're going to do to bring that down. And as Anna was pointing out, in terms of fiscal spend, where is the political will to make that happen? So I think it is still probably maybe the Fed you got to look for.
Or Taylor Swift. Honestly, maybe it's not Jay Powell. Maybe it's not the president. Maybe it is just Taylor Swift.
If you're talking about Taylor Swift,
We're peak Taylor Swift. If I'm talking about it, this is peak Swift.
This is, you want to be shorting Taylor Swift right here, is what I'm saying. Like, I feel like you are a counter indicator of kind of where we're going to be going. This is my point. All right, guys. Anna Kerr and Liz McCormick, thank you both very much. Are we at peak Swift? I feel like that is the question of the day. Guys, thanks a lot. All right, more on the question of the day is inflation re-acceleration. Encore Crawford is Alger Executive Vice President and Portfolio Managers. Coming up next, this is Bloomberg.
Will the ECB hike or pause this week?
There's a lot in flux at the moment.
ECB, they're stepping harder and harder on the brakes.
You have to be cautious.
It's much too early to think about a pause.
Inflation expectations remain anchored at 2%.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Is there a real danger of over-tightening at this point?
Stopping too early is a bigger problem.
Coverage begins Thursday on Bloomberg. Context changes everything.
What we know is that wage pressures, again, remaining firm in real terms, but it's coming in the context of inflationary pressure that's now slowing down. I mean, this 2/10 that we got, I get it, firmer than expectations, but that still doesn't change the trend. The trend of inflation is actually moving slower. So that means that the pass-through is becoming much more difficult for companies.
That was Tom Porcelli, PGIM fixed income chief U.S. economist, talking about inflation on Bloomberg TV earlier, which brings us to the question of the day. Inflation, re-acceleration? Well, joining us now is Encore Crawford, Alger Executive Vice President and Portfolio Manager. Encore, what do you think? Inflation re-acceleration or no?
You know, I don't know if we're re-accelerating, but as I said before, 2% inflation feels like it was an anomaly over the last couple of decades. Could actually reside between 3 to 4%. And that's the resting spot for inflation because all of the impetus to get it to 2% is now over. So I'm a believer that we will reside between 3 to 4% inflation, and we're just going to have to live with it.
What does that mean for financial markets, Encore?
I think the markets are starting to get used to the fact that 3% inflation is actually not a killer for the market. But 2%, I don't know if anyone really believes that 2% is achievable anymore as well. So,
okay, but to that point then, if we have to live with 3 to 4, what does the Fed do with that? Does that mean we're going to be higher like forever?
I think we're higher for longer for sure. However, what is the resting spot for that inflation will dictate where the Fed lands. So if the resting spot is closer to 3, 2.9, 3.2, the Fed can probably stop and start taking it down at the end of next year as it sees the economy slow. So I think the Fed right now should be really fixated on the data that is coming from the economy versus the inflation. Inflation is just going to be an indicator of how will the economy slow from here.
What is that going to mean for real growth? What kind of growth rates do you think we're going to be looking at? Here in Europe, it looks like we're heading for stagflation. We're going to have relatively high inflation. Growth looks like it's rolling over. You can see it in the Eurozone. You can see it in the UK. Data out today proving that point. Is it going to be a similar story in the United States?
I think there's going to be parts of growth that are going to be pressured. If you look at the consumer is definitively going to be pressured. You have so many different headwinds that are starting to come onto the consumer. However, there is a growth story inside of the U.S. that I think is very different than it is in Europe or any other country. And that is this idea of Gen AI and the adoption of AI, which, in the near term, will it have a significant impact? Probably not. But as we go through 2024, it will have an impact on the numbers, especially for some of the Magnificent Seven.
Okay, so which ones, I guess, and which ones haven't already baked that in? Because it's also, you're pricing in hope, right? In essence?
So I think last time I was in here, we talked about NVIDIA and NVIDIA, like how much further can NVIDIA go? The numbers for NVIDIA just went up significantly again.
But the stock didn't really do much.
Yeah, but you know what? When a stock goes up 250%, a down 10% move is almost a breathing period for the stock versus it being, significantly a significant catalyst in the wrong direction. So what is baked in? When Meta trades at a 15 multiple and Microsoft trades at a high teens multiple or Google trades at a high teens multiple, those don't feel like it's baked in terms of the growth that we expect.
What's the degree of certainty at the moment? If I'm an investor, I've got money in a money market account, and I'm trying to figure out whether or not I should put that money back to work. Do I put it in bonds? Do I put it in equities? Do I put it in single stocks? Do I put it into the market more broadly? What would you say? Is now a good time to strike? Or do you think the period of uncertainty that we're going through is going to last a little bit longer, but clarity at some point soon will be available?
I think the next few months for the market's going to be pretty choppy, and it's going to be less directional than it has been the first 9 months of this year. And in part, if you look, like, China is definitively slowing. You just mentioned Europe effectively being in stagflation. The U.S. consumer is seeing these pressures of not only higher rates, but paying back student loans, and increase in oil prices. So I think there's a lot of headwinds that are coming to the fore over the next few months that we really have to test and see how it plays out in the economy, which, when there's uncertainty, the market really struggles to find its direction.
So going back to the tech idea, like you mentioned Meta, Microsoft, we had mentioned NVIDIA, the ARM IPO. How are you, would this be interesting to you? How are you going to be viewing how it performs and how it does, considering that it really sits in the sweet spot of NVIDIA and also that potential growth that you're talking about?
Yeah, so ARM is a really interesting business, and in fact, the business model is such that it's one of the most beautiful businesses because it's a royalty business. So the way they are pricing it, SoftBank is only selling 10% of their stake. The way they're pricing the IPO is actually pretty attractive. We think it's about a 25 times earnings multiple on a 2025 number. For a business like ARM, that also doesn't seem egregious, where they're not only having their own form of pricing power, but it's going to reinvigorate their growth. So ARM, it'll be interesting to see how it trades. I expect that it will trade up, and they've priced it to trade up.
Fair enough.
ARM is clearly exposed, very exposed to the handset market, as is Apple, it turns out. What did you think of last night? Do you think Apple delivered anything that's going to make people want to go out and buy the stock? Didn't feel like it. The response in terms of the new handsets doesn't feel that great. This is a company that's gone ex-growth, yet it is a massive portion of many people's portfolios. What do you think of Apple right now? Is this just indicative of what is happening more broadly? The consumer's running out of money, you've got high-priced products, people are going to be cautious about maybe spending that kind of a cash. What do you think about putting Apple in the portfolio?
Yeah, so Apple is a tricky one, in part because a lot of Apple's growth over the last decade or decade and a half has been driven by China. And you see what's happening in China, where there's almost like an anti-Western sentiment, especially geared towards Apple as of late. So I do think that the growth engine of China for Apple probably has a near-term pause. That said, 40% of Apple's earnings comes from their services revenue. And that services revenue is almost utility-like in nature. It's the storage that you pay on your iPhone, which, we're only increasing the amount of storage and the number of photos that we have in the cloud. And so there is almost a stability aspect to the stock, although granted, I do worry that the handset numbers are going to come under pressure, not only in China, but also in the U.S., as the consumer feels more pressure.
Whatever, we still have to go buy a $69 charger thingy-ding or something. All right, Encore, thank you so much. Encore Crawford of Alger, we appreciate you stopping by. So let's talk about all of this next. ARM expecting to price its IPO top end of the range, maybe higher. We're going to get an update on the biggest new share offering of the year. Next on the startup. Guy, you don't have an iPhone, right?
No. But over here we use WhatsApp. Over there you all communicate with your Apples.
That's true.
Different ballgame.
All right, this is Bloomberg.
Day, like Bloomberg.
It is 23 past 7 on the West Coast. Let's get to the startup, where we cover the top tech stories from the Bay Area and beyond. The Silicon Valley starts its morning. Ed Ludlow, Bloomberg Technology co-host, joins us now. It's a gloomy day. It's a gloomy day for Apple. The stock down about 1% over the last 2 days. What did you make of yesterday?
Yeah, overall, it was a really interesting launch. The first thing we should say is that everything that Mark Gurman reported would be announced was announced. So we kind of went into it knowing that would be the case. The surprise was therefore the price on the iPhone 15 Pro Max. $1,199, $1,200. And so the debate we all have with ourselves as consumers is, were the technology upgrades enough such that we're willing to part with $1,200 for the top end smartphone? And the reaction's been really interesting. The street seems to be like, yep, you know what? We see that growth driving top line growth. You know, even if they can't drive unit volume, there will be buyers at the higher price point. But, you know, Guy doesn't have an iPhone. But if you are a photographer or you want to play video games, then the iPhone 15 Pro and Pro Max do offer a genuine upgrade to the technology that makes it attractive.
Yeah. I'm not sure there's anything in here that's going to convince me to want to buy it. The price point is absolutely eye-watering. I was looking at my son last night. Ed, is there enough here, though, to counterweight the concerns around China? Because that's the debate right now.
Yeah, so I spoke to a lot of analysts and market analysts on the ground yesterday, and they basically say yes. China consumers do emphasize performance. They want the latest technology. So Apple's saying, here's a $1,200 phone, but it has our latest silicon in the A17, 5x zoom on the camera, which is a big upgrade from the prior generation of Pro Max. It has ray tracing abilities, which makes next-gen video games possible. That appeals to a Chinese consumer. But they didn't do it in any colors that are good for the Chinese market, red and gold. And you might be thinking, what is Ed talking about? But that was a really interesting point. They're offering the Pro and Pro Max in blue, gray, black. In the Chinese market and in Chinese society, you know, red is a really important color, as is gold, and they didn't offer those. I thought that was interesting.
Before we let you go, ARM IPO today. Pricing of the range. Is that a pure supply and demand thing?
I mean, they're 10 times oversubscribed, right? But they are only offering a very limited number of shares, and $700 million worth of those are going to their biggest customers. So, you know, how many IPOs have the three of us covered where they're oversubscribed? Like every single one. But I think there is intense interest here because, you know, the point of an IPO isn't just to raise money for a company. We know that SoftBank is going to retain a much higher proportion than initially planned. But an IPO is also for marketing. It's to get the name out there, and that appears to have worked.
Yep, we're going to talk Birkenstock next as well. That's the next one potentially we need to focus on. Ed, you've got some great coverage coming up with Caroline on Bloomberg Technology. That show in around 90 minutes' time. Up next, we're going to talk to Stefan Bancel, Moderna's CEO.
We're about an hour into a trading session. Bloomberg's Abigail Doolittle is tracking the moves. I gotta say, not a lot of action in the equity market, Abigail.
Yeah, non-move. Take a look at the S&P 500 up fractionally. You have the Bloomberg Dollar Index down fractionally. Investors really searching for direction. We had a couple of up days, and then yesterday a bit of a down day. Investors trying to sort out CPI. We, of course, will have retail sales tomorrow, then PPI next week. The Fed, though, that's probably the main event. The 10-year yield right now, nothing happening there at all. You can see we have a little bit more action for some of the China tech stocks, down about 0.3% at the lows, down more than that. Lots of stories out of China right now, including the EU pressuring China, some protectionist activity here. So you have the global China EV car maker index down about 2% on the day. The EU looking into starting an investigation on whether or not Chinese subsidies around China EVs are stealing basically share from some of the German automakers. Initially, the German automakers and the European automakers rallied on that. Now they're kind of flat, but you can see pressure. The big question is, will China or those China EVs, will they retaliate back in some way? As for another part of the China markets, well, Country Garden, the beleaguered property developer, the largest property developer over there, bond after bond, they're voting on whether or not they should be repaid. A bond vote recently was successful that they will be extended for about 3 years. You can see, though, Alex, these bonds, 3 of these dollar bonds on Country Garden trading at about 10 cents on the dollar. Not a lot of confidence, and this is a story that we will be looking at over and over again in the weeks, months, and maybe years ahead.
All right, Abigail, thanks so much. Really appreciate that. So in the S&P, Moderna is actually the best performing stock, up by about 5%. The company is hosting its annual R&D Day in New York. Now, it did say it expects to add about $10 to $15 billion in annual sales by 2028, hence that pop. Well, here with us in studio is Stéphane Bancel, Moderna CEO. So great to see you, I think, in person. This is the first time I think we've decided it's been in person. Let's get to that top end of $15 billion over the next few years. What mix is that? COVID, RSV, flu, cancer?
Yeah, so good morning and thank you so much for having me. So the respiratory vaccines, as you say, COVID, RSV, flu, will be the bulk of it. What we still need to figure out is when do we launch the cancer product. We are very excited about the data. We need to wait for a bit of more of a readout. I think we said this morning by the end of the year we should have more data we will share. And that might be an interesting point to start talking to the regulator about potential accelerated approval.
Stéphane, good morning. It's Guy. Great to see you as well, though not in person. Maybe next time. Let's talk a little bit about the risks to that upgrade. Are you still being cautious? Do you think there's potentially even more to come here? Kind of as these drivers start to kick in, could this be a process where you kind of continuously are upgrading some of these outlook numbers?
Yeah, so what we believe is the products are really working really well. If you look today, the numbers are going up, which is what we expect. It's a fall season. You know, we're going back inside. Kids are back in school, so things are going to propagate. It's like what we see with flu, as we've been saying all along. COVID is going to look like flu over time. Mm-hmm. People at higher risk are going to need an annual booster. We're very pleased that the FDA just approved in the US the booster, you know, on Monday, CDC yesterday. I got a photo during the night that the first trucks were going to the pharmacies. Mm-hmm. So it's going to be the same every year. What we're trying to do now with the positive flu data is to combine flu and COVID. Mm-hmm. We have talked about it before on your show, guys. Yep. We should have, before the end of the year, the COVID-flu combined data, which should, if it's positive, go into a phase 3 next year for a potential launch in 25.
What is the downside risk that the COVID vaccine becomes more cash burning than cash supporting?
Well, at the current scale, I mean, if you look $6 to $8 billion for this year, as we've said, so you're in a profitable business when you have $6 to $8 billion of sales on the product. So it's going to be cash supporting.
But this assumes that we're going to have the same kind of take up for the continued vaccines that we had before, right?
No, actually, the numbers are much below. If you look at last year, we had around $18 billion of sales. So now we're saying 6 to 8 this year. Okay. So it's coming down a lot because of vaccination rates, meaning not everybody in the US is going to get their vaccine. So we think that if we have 50 million people, to give you a sense, flu last year was 150 million doses in arms. So if you get 50 this year, that's the 6 billion range we'll be at. If we get more closer to 100 million doses, that would be the 8 billion range. And so out of the 6 to 8 billion business this year and moving forward, we think we can generate cash in addition to the $14 billion of cash we have on the balance sheet. We should be able to invest in research and create this amazing pipeline. We think 15 launches in the next 5 years.
Okay, let's talk about the next 5 years. Let's talk about the next 10 years as well. Looking further down the road, Stefan, where do you see the biggest opportunity now? Is it in respiratory? Is it going to be cancer? How is the mix going to change over time?
So I think respiratory is going to still be very big because once you have COVID, RSV, and flu, and then combinations, as we said, this is going to be a $15+ billion annual sales franchise forever, because those respiratory vaccines are not leaving the planet. And those combinations, we believe technologically, you can only do with mRNA. So the protein players, people making egg technology, I think this is going to go away over time. Then cancer. Cancer is going to be very, very big because, as you've seen in the data, when we add this to Keytruda checkpoint product, you have a very significant response. Let's go back to the data. 44% of reduction of deaths or recurrence of disease versus the best drug on the market. Not the average drug, the best drug on the market. That's in melanoma, in skin cancer. By the end of the year, we're starting lung cancer. We believe that everywhere where Keytruda works, it's going to work. The other piece that I think is very exciting for patients is that, as you might have seen with GRAIL as part of Illumina, there's more and more of a liquid biopsy, the ability to find little fragments of cancer cell DNA in your blood, just for blood draw. And we think this will allow us as a society to be able to go earlier in cancer, stage 1 or stage 2 cancer. As you know, most cancers become deadly when you catch them very late.
Yeah.
So if you could do an annual blood check, where in your blood you can tell you, hey, you have cancer, and we can make for you in 30 days a product customized for you.
I mean, that would be amazing.
But that's where cancer is going.
But who's going to pay for it? So just anecdotally, my mother got her RSV vaccine, and it's not Moderna, but it was $340 out of pocket. And she's on 2 types of Medicare. So who pays for it? Who sets the price?
So in terms of the RSV product, this should be reimbursed. I assume, and it's not my product, so I cannot speak for it.
No, but in terms of like, is the government going to set the price for you? Is it the insurance companies, or is it going to eventually have to be the end consumer?
It's going to be the insurance company and the government, but if you think about the cost of keeping somebody alive with cancer today through multiple rounds of chemo, the loss of productivity, the quality of life, it's just gigantic for society. So if you can really get cancer caught early, the impact it will have on cost is tremendous, and that's where we think we are going. And that's why I think it's an amazing time in cancer right now, between the liquid biopsy and this type of technology where we make an individualized product, that if I have prostate cancer and my brother has prostate cancer, he and I will get different molecules. We at Moderna, in 30 days, we make a different molecule that will be adapted to what my immune system needs, so it can recognize the cancer and go eat the cancer cells.
Okay, so much to unpack here. Do you need to be in the blood testing business? Is that something somebody else can do? How do you see that working? Is there a possibility of a sort of obvious combination there? And in terms of that 30 days, just talk to me about where the next leap comes. Is it AI being plugged in and you getting faster responses? How does this progress?
Sure. So on the diagnostic, we don't need to acquire diagnostic companies. What we'll do is we'll move data. Again, it's a world of data, as you guys know well. We'll move data from the diagnostic companies who will have basically do your blood draw and figure out you have cancer, move that data to Moderna's IT system. It's all in the cloud. And where we use AI a lot already pre-ChatGPT is the algorithm that picks the mutation I will get. This is the one my brother will get in my example. Today, when we have cancer, we don't have 1 or 2 mutations, we have hundreds or thousands of mutations on the 3 GB of letters in our DNA. And what we're trying to do with our system is to learn from what we're observing in the clinic that's working. So basically, in the current Moderna product, we pick 34 mutations of the hundreds of mutations I might have in my cancer. But what we're going to be able to look at is those mutations we picked for an AI systems, which ones are working, which ones are not working. So we can update the software and get a product that's going to get stronger and stronger. So I believe that 44% improvement I talked about before, over time will get better.
Can we just end on the finances again? So you're mentioning that the pickup from the vaccines this year, 6 to 8 billion. But I'm wondering, what you're talking about seems to be a lot of R&D also. what's like the price you need to sell your stuff for to make all of this work? Like at what point does it get too hard for Moderna?
I don't think it gets too hard because of a probability of success. If you look at pharma, because it's an analog way to make drugs, not information like us, mRNA, 90% of the drugs in pipeline in the clinic fail. Look at where we are today at the beginning of this new age
so you
of
have
a
less
platform.
Time to fail. You're going to have less time to fail, which helps your bottom line.
Yes, I mean, think about it. 3 out of 3 vaccines working in infectious disease. 3 out of 3 rare disease having positive clinical signal. That's unheard of. That's not because we're smarter. I don't believe we are. It's because we have a platform using the same chemicals, mRNA, to code different instructions in your body, but the same product that we give you. And that's why the drug success is going to be much higher.
Well, stock is definitely up. Best performer on the S&P today. Stefan, it was so good to catch up with you. We wish you all the luck. Stefan Bancel, Moderna CEO. All right, coming up, Chile is hosting its annual investors event in the United Kingdom, I think, yes. As the country is wrestling with inflation problems, we're going to speak with the Chilean Minister of Finance. Joins us with more next. This is Bloomberg.
So, Chile is hosting its annual investors event in London. Now, let's talk about the country's economy. It's been hit hard. Santiago basically has been battling to bring inflation under control. That has hit growth. However, this country remains critical. It is a critical copper producer globally. It's also ramping up lithium production. What happens in Chile has a global impact. Mario Marcel is the Chilean Minister of Finance, and he joins us now. Minister, fantastic to see you. The economy has been hit reasonably hard as you have battled inflation and brought inflation lower. Are we near the bottom? Is the worst now behind you for the Chilean economy?
Yes, we had a major challenge when the new government took over, since inflation was going up, prompted not only by global developments but also by domestic factors, especially by the overexpansion of economic activity in 2021. Last year, we started combining fiscal policy with monetary policy to stabilize the economy, and that job is almost complete. The economy, fortunately, the adjustment has reflected mostly in stabilizing the level of GDP, with some moderate declines at the last year. But inflation is now down to a third of what it was a year ago.
Yeah.
The latest reading for August is 5.3%, and it is expected to reach 4% by the end of the year, pretty close to the 3% target of the central bank.
Minister, to that point, you're in London for a reason. Europe, in many ways, is desperate for a secure, reliable chain of minerals that don't depend on China, like copper, like lithium. What are your conversations like with government officials and companies on this?
Well, basically that we have already solved one important aspect of mining industry, which is the royalty on mining that was passed by Congress a few months ago. This was, in our view, was sorted out pretty successfully by increasing the share of government in copper revenues, but at the same time putting a cap on overall tax burden for the industry that will create much more certainty moving into the future, especially for new investment projects.
It is critical, the products that you supply for the global economy, but it's going to be interesting to see where your products ultimately end up, Minister. China is a big customer of Chile's right now. They buy a lot of copper from you guys. Europe would like to buy some of that copper, buy some of that lithium. Minister, do you think you're going to have to pick sides? Do you think you're going to have to either pick China or the West in terms of who you ultimately end up supplying?
Well, Chile is a very open economy. We don't usually pick sides because either on the investor side or on the client side, our economy is open to all counterparts. We don't see a need to get involved into that, and right now what is happening is that with the deceleration of the Chinese economy and all the difficulties that they're facing, what we're seeing is very strong demand for copper that comes from more structural changes all over the world towards electromobility. So we have a very broad client base to engage with.
So what do you think the copper price can get to?
Sorry, I didn't get the question.
What price do you think copper can get to?
Well, the price of copper, despite all the deceleration in China, the prospects of recession in the U.S. has remained above $3.50 per pound. So I think that that is pretty much reflecting this strong basis for copper demand, combined with other prices of in our foreign trade. Terms of trade for Chile are 20% above historical levels. So we are, in terms of pricing, I think that things look much better than usually at times when larger economies are contracting.
Minister, thank you very much indeed for your time today. We greatly appreciate it. Really interesting insight into what is happening, as you say, as the economy, as the global economy electrifies. Chile is going to play a large part in that process. Mario Marcel, Chile's finance minister, thank you, sir. What are we going to talk about next? Layoffs at Citigroup, the Wall Street giant bracing for a wave of job cuts as its CEO, Jane Fraser, revamps top management and the top management structure. Details on what is happening. Bit of a surprise today. Wall Street beat coming next. This is Bloomberg.